61% is the most important number inside Meta's corporate structure today. Not revenue growth, not users, not profits. Only voting power ultimately decides control. That single percentage determines who controls Meta, regardless of market reaction. It means Meta's CEO cannot be removed by shareholders, no matter what happens. Losses, scandals, fines, or outrage do not change who stays in charge. This is why Mark Zuckerberg cannot realistically be fired from his own company. And this has nothing to do with personality, ego, or political influence. The explanation is structural, legal, and written into the company's design. This story is about rules created long before Meta reached its current scale. Those rules still quietly govern every major decision Meta makes today. Once governance rules are locked, outcomes stop being optional. Most public companies include an escape mechanism inside their governance systems. Shareholders elect directors to represent their collective financial interests. Directors then hire or fire executives responsible for daily operations. If performance collapses badly enough, leadership eventually changes. That feedback loop keeps power responsive to results and shareholder pressure. Meta appears to follow this familiar model when viewed from the outside. Public shares trade freely while analysts debate earnings and strategy. But internally, the voting mathematics work very differently. This is where the system quietly breaks. Meta has two distinct classes of common stock written into its structure. Class A shares carry one vote for each share owned by investors. These are the shares held by most public and institutional shareholders. Class B shares exist alongside them with enhanced voting power. This is where the balance of control begins to shift. Each Class B share carries 10 votes instead of one ordinary vote. Nearly all of those Class B shares belong to Mark Zuckerberg himself. This concentrates decision-making authority into a single position, quietly, legally, and entirely by design. Zuckerberg controls roughly 61% of Meta's total voting power today. Yet he owns only about 13% of the company economically. Ownership and control are deliberately separated inside Meta's governance model. That separation defines how power actually functions inside the company. This is not ownership in the traditional sense of shareholder capitalism. It is command, enforced through voting mathematics rather than capital. It allows outcomes to be decided without majority financial ownership. Meta discloses this structure clearly in its proxy and governance filings. Nothing here violates the law, which is precisely why it works. Markets can react strongly when they dislike a decision. Share prices can fall and sentiment can turn negative. But none of that alters who controls the vote. Shareholders can disagree with management unanimously if they choose. They still cannot outvote the controlling shareholder under this structure. Coalitions of investors cannot overcome the arithmetic of voting power. Activist campaigns fail by design, not lack of effort. At this point, shareholder voting becomes largely symbolic. Outcomes are effectively determined before ballots are ever cast. This is where traditional market discipline stops working, and this is only the first structural break. Meta's board of directors operates entirely inside this framework. Directors are elected by shareholders through formal voting processes. Shareholders lack ultimate authority over the final outcomes. Accountability begins to thin at this exact point. Oversight exists, but only within boundaries that cannot be crossed. Those boundaries are invisible to users, but absolute in practice. Advice can be offered, but enforcement power weakens significantly. Incentives begin to shift as control becomes permanent. Power flows consistently in one direction inside the company. That directional flow reshapes incentives at every organizational level. Without credible removal risk, strategic behavior begins to change. Leadership time horizons extend far beyond quarterly expectations. Short-term market pressure loses much of its usual influence. This can protect long-term investment strategies from panic. Meta survived the mobile platform transition partly due to this insulation. Instagram took years before serious monetization arrived. WhatsApp took even longer to produce meaningful revenue streams. Founder control allowed patience. Public markets rarely tolerate, but patience carries a hidden cost over time. This is where fragility begins to form. Insulation delays necessary strategic correction when errors appear. Mistakes do not immediately threaten leadership positions or authority. Markets normally discipline executives through replacement risk. At Meta, that corrective signal is muted. Only the stock price reacts to disagreement or disappointment. Control remains unchanged, regardless of investor dissatisfaction. Errors persist longer than they otherwise would. Quietly, systemic risk accumulates beneath the surface. Then comes the second and less visible lock on control. In most public companies, control can be purchased over time. Takeovers act as a final external discipline mechanism. Meta blocks that pathway intentionally through share design. Class B shares convert when transferred to another holder. They become lower power Class A shares upon transfer. Voting power, therefore, does not move freely through markets. Even billions of dollars cannot buy control. Hostile takeovers are effectively impossible under this structure. Founder-led gradually becomes founder-sealed over time. Power changes hands only if it is voluntarily surrendered. This outcome is not accidental or unintended. Meta today is no longer a startup experiment. It shapes global advertising markets at massive scale. It influences how information flows through modern societies. It indirectly affects political communication worldwide. Billions of people rely on its platforms every single day. Yet the leadership structure remains fixed and unchanged. As influence expands, pressure increases across the system, but control does not move in response. This matters most during moments of public crisis. After Cambridge Analytica, governance failures became visible. Regulators imposed fines and oversight requirements. Meta later agreed to a shareholder settlement near $200 million. The cost was real, but the structure remained intact. Leadership did not meaningfully change afterward. Courts did not force structural reform or control changes. Law protects structure, not sentiment. Meta is incorporated under Delaware corporate law. Delaware strongly respects internal governance design choices. As long as fiduciary duties are formally satisfied, control remains legally intact and enforceable. Collapse economics focuses on feedback failure inside complex systems. Systems fail when corrective signals weaken or arrive too late. Founder-controlled firms can outperform markets for many years until correction finally arrives. Late corrections are often severe and destabilizing. This is not a prediction of collapse. It is a description of structural risk accumulating quietly. Shareholders buy exposure to results, not control over decisions. Stability without correction feels strong during calm conditions, but strength without correction struggles during rapid change. And those consequences tend to arrive suddenly, not gradually.